I want you to picture two Bitcoin investors. Same city, same year. Both bought Bitcoin around the same time. The first investor checks the price 14 times a day. They have a specific number in their head, the number where they plan to sell. They've watched 3 YouTube videos this week about the halving cycle. They know exactly which month the bull run is supposed to peak. They feel confident. They feel prepared. The second investor checks the price occasionally. They don't have a sell number. They're not thinking about this cycle at all. They've quietly been adding to their position while most people were panicking and selling. They're not watching for a peak. They're watching something else entirely. Here's what's strange. The first investor will likely make less money, possibly far less. Not because they're unintelligent, not because they picked the wrong asset, but because they are preparing for a version of Bitcoin that no longer exists. This is the part nobody is telling you. The playbook that made early Bitcoin investors wealthy has fundamentally changed. The rules that governed every cycle from 2013 through 2021 are breaking down in real time. And the majority of retail investors are still playing by the old rules in a game that has quietly moved on without them. Today, I'm going to walk you through exactly what changed, why most people haven't noticed yet, and what the investors who are actually positioned correctly are doing differently. Let's start with the belief that almost every retail Bitcoin investor holds as gospel.
The 4-year cycle. The idea is simple. Every 4 years, Bitcoin cuts the amount of new coins entering circulation in half. This is called the halving. Less new supply plus growing demand equals a price explosion. It happened in 2013, it happened in 2017, it happened in 2021. The pattern was so reliable that a cottage industry of analysts, YouTube channels, and price models was built entirely around predicting exactly when the peak would arrive and how high it would go. Investors planned their lives around it. They set price alerts. They mapped out exit strategies. They calculated the month they would sell. Then, 2025 happened, and the script broke. For the first time in Bitcoin's history, the year following a halving finished in the red. Bitcoin hit a new all-time high of around $126,000 in October 2025, then fell more than 30% in the final weeks of the year. Investors who were waiting for the classic blow-off top, that vertical price spike that marked the peak in every previous cycle, never got the signal they were trained to look for. Many held through the drop, expecting the old pattern to resume. It didn't. This wasn't bad luck. It wasn't manipulation. It was the logical consequence of something that changed the structure of the Bitcoin market permanently. Here's what actually happened. In January 2024, the United States approved spot Bitcoin ETFs. For the first time, massive institutional investors, pension funds, endowments, asset managers like BlackRock and Fidelity could buy Bitcoin directly through regulated financial products. The money that entered the market wasn't individual investors refreshing their Coinbase apps. It was institutional capital moving in structured, deliberate flows worth hundreds of millions of dollars per day. Consider this single comparison. The April 2024 halving reduced the daily supply of new Bitcoin to roughly 450 coins per day. At $90,000 per coin, that's approximately $40 million of new supply entering the market each day. On active days in 2025, Bitcoin ETF inflows alone exceeded $1 billion. The ETFs were moving more than 25 times the daily mining supply in a single day. The halving, the event that drove every previous cycle, became almost mathematically irrelevant to price. The force that now moves Bitcoin isn't miners, it's institutions. And institutions don't behave like retail investors. They don't check prices 14 times a day. They don't panic sell during corrections. They don't follow YouTube analysts. They have long investment horizons, disciplined risk frameworks, and they treat temporary price drops as buying opportunities, not emergencies. By late 2025, institutions controlled roughly 30% of all circulating Bitcoin supply through ETFs and corporate treasuries. Meanwhile,
something alarming was happening on the retail side. While institutions were accumulating, retail investors were exiting. Large transaction volumes increased by 59% in 2025. Small transaction volumes, the kind that represent individual investors,
dropped by 66%. The people who understood the new structure were buying. The people still following the old playbook were selling. This creates a problem that most retail investors haven't fully confronted yet. The signals they've been trained to watch no longer mean what they used to mean. A price dip used to signal retail panic and potential capitulation before a recovery. Now, it might signal institutional de-risking as fund managers respond to broader market conditions entirely unrelated to Bitcoin specifically. A price surge used to mean retail excitement and FOMO. Now, it might mean a pension fund rebalanced its portfolio allocation. The psychology of the old market and the mechanics of the new market are completely different. Investors using emotional retail signals to navigate an increasingly institutional market are essentially reading the wrong map.
So what does the right map look like? The investors positioned correctly for this new era are watching three things that most retail investors ignore completely. The first is ETF flows, not price, flows. When institutional money is moving into Bitcoin ETFs consistently, that represents genuine structural demand. When ETFs are seeing outflows, that represents institutional selling pressure, regardless of what any price chart suggests. ETF flow data is publicly available every single day. Almost nobody in the retail community is treating it as their primary signal. The second is global liquidity conditions. Bitcoin in the institutional era behaves less like a speculative asset and more like a high-sensitivity macro asset. When central banks are loosening financial conditions and money is moving freely through the global economy, Bitcoin tends to rise. When conditions tighten, Bitcoin tends to fall. This connection is stronger now than at any point in Bitcoin's history, precisely because institutional investors manage Bitcoin alongside their other assets and respond to the same macro triggers.
The third is corporate treasury accumulation. When publicly traded companies begin adding Bitcoin to their balance sheets at scale, that represents demand that doesn't sell during price dips. It sits, it holds, it creates a floor that didn't exist in previous cycles. Corporate treasuries globally held over 1.6 million Bitcoin by the end of 2025. That number is growing. None of these signals fit neatly into a 4-year cycle model. None of them peak in a specific month and then collapse. They are slow, structural, and they reward patience in ways that short-term cycle trading simply cannot. Here is the uncomfortable truth about where most retail investors are right now. They are sitting at a poker table, playing by the rules of a game that ended 2 years ago. They have a strategy that worked brilliantly 3 times in a row. They are confident in that strategy, and the entire structure of the game has changed around them while they were studying the old hands. The investors who are building real positions understand something simple. Bitcoin didn't stop being valuable. It stopped being predictable in the old way. The volatility is still there, the risk is still there, but the rhythm, the neat 4-year clockwork that let a specific kind of investor feel like they had a system, is gone.
What replaced it is something more mature and, honestly, harder to exploit quickly. An asset increasingly integrated into global finance, subject to the same forces that move bond markets and equity indexes, requiring the same patience and institutional thinking that traditional long-term investors have always used. The investors doing well in this environment aren't the ones with the most sophisticated cycle models. They're the ones who accepted the simplest and most uncomfortable idea, that the future they spent years preparing for quietly became the past. And the investors who adapt to that reality now, rather than later, are the ones who will look back at this period the way early investors look back at 2020, not as a time of confusion, but as the moment when everything was obvious in hindsight, and almost nobody was paying attention. The question isn't whether you understand Bitcoin. The question is which version of Bitcoin you understand.